developing innovative products, which basically offer an easy solution to invest into the Indian markets. And today, again, we are adding another product to our kitty of these simple and effective products. And we are happy to announce uh, the launch of ICICI Prudential Equal Weight Index Fund. This is a smart beta passive index fund which offers equal weightage in the top 50 blue chip companies of India. And today I'm joined by Mr. Chintan Haria, who is the head of product and strategy at ICICI Prudential AMC, and he will give us more information regarding this fund and why it is a good fund and a good choice to have it in your portfolio. So over to you, Chintan.
Yeah, thanks, Karan, and thank you, team, for allowing us to share our thoughts with you on this NFO and the markets itself. If we look at the markets in general over the last 6 to 8 months, clearly India's dominance and outperformance has been significant, and that has been led by two major factors. One is, if we look at the globe, people will probably see the slowing down of US economy. Europe itself is in trouble because of higher energy costs, because of high gas prices, as Russia has stopped supplying to Europe, and that has caused a significant pain in Europe. Inflation rates there are at 40-50-year highs. Even in US, inflation is at a 40-year high, and they've been forced to increase their interest rates significantly. Just a couple of days back, Sweden increased their interest rates by 1% from 0.75 to 1.75. So these are economies which are used to having practically zero inflation, zero interest rates. And with inflation and interest rates coming back, they'll probably need to readjust. And the first readjustment will happen is the curtailment of the economic activity. So there is a chance that Europe will go into slowdown or a recession significantly, and that will obviously have a negative impact on US as well. If we extend that argument towards China, while valuations are supportive and cheap, there are internal problems which we probably can't be sure of what's happening. Hence, this is one reason where if an investor has a lot of money, and the world has a lot of money, India is only 3% of the global GDP and 3% of the global market cap, while the market caps in US, Europe are much, much larger. So money will find its way, and we can see anecdotal evidence. There's been one conference of a local broking house in which the interest levels are so high that there have been 17,000 requests. So domestic investors is the second reason why the buoyancy in the economy is significant. We have only 4.8% of our savings of $10 trillion in equity, and that has basically led to even a small portion of 4.8% has led to the significant outperformance. Think of it this way, that foreigners took... Karan, are you able to hear me?
Yes, Chintan, I can hear you.
Sure. I was just facing some network troubles. I just wanted to be sure. Thanks. So if we look at from a India perspective, like I said, we've just scratched the surface in terms of the way we are investing in equities. We have 10 crore demat accounts, 3.5 crore mutual fund investors, and look at the numbers. From October 2021 to June 2022, foreigners sold 3 lakh crores in Indian equity, and they were able to bring us down from 18,000 on the Nifty to 15,000 on the Nifty. And in August, it just took 60,000 crores for us to go back from 15,200 or 300 to almost 18,000. So clearly, the positivity of domestic customers is helping lower drawdowns, or we are falling much lesser. And if foreigners have no choice but to come to India, then that is also helping our markets. And that is also factored in valuations to a very large extent, wherein our valuations are at long-term averages or slightly more. But we can be expensive for a slightly longer time, because India is the only country where food security and energy security is quite good. So we will see interest coming in, and we may become even more expensive than where we are. In that backdrop, there is a very high chance that a lot of the sectors will end up doing very well. And hence, from a investor opportunity perspective, we are very happy to bring the Nifty 50 index equal weight index fund, which essentially is a slight variant of the traditional Nifty 50 index fund. So the constituents of Nifty 50 index are the same as the Nifty 50 equal weight index, also has the same 50 stocks. The only difference is, as you can see, and I'll directly go to that particular slide to make it very clear. If you look at the comparison, in Nifty 50 as on August 30th, 2022, a stock like Reliance, HDFC Bank, ICICI Bank, Infosys will have weights of 11.5, 8, 8, 7. But in the equal weight index, the size of the stock does not matter. If it's a top 50 stock, which is part of Nifty 50, it will have equal weight. What this does is, if you look at the diversification from a sector level, you look at, say, a sector like IT. IT had at its peak in March 20% weight, with I think about 5 stocks in the index, right? 5 stocks, 20% weight, because Infosys and TCS had a much larger weight. Compared to that, in the equal weight, IT had only a 10% weight. So when IT fell by 30%, in the Nifty 50 index, IT fell 6%. IT index contributed 6% fall, while in the Nifty 50 equal weight, the fall was only about 1.5 to 2%. So effectively, because equal weight is more diversified in terms of sectoral allocations, you find that in a market which is widespread or diversified and does well, equal weight tends to do well. And that is reflected in the performance, as you can see, on an annual basis, right? If you look at the annual performance for the equal weight versus the Nifty 50 TRI over the last 12 to 13 years, there are years where obviously the Nifty does well, and we saw 2018 and 2019, where all of you would remember that beating the Nifty 50 was almost impossible, because the top 10 names in Nifty, which accounted for 70-75% of the weight in Nifty, did very well, while the rest of Nifty and the rest of the market did extremely badly in 2018-19. So you can see in 2018-19, it was only Nifty 50 which did well, gave a positive return of 15%, while the equal weight was almost flat. Next, come to the year like 2020, 2021, and I'd like to probably highlight in 2021, the equal weight went up by 35%, while Nifty went up by 25%. Why did this happen? Because if you look at sectors like, say, metals or even auto, metals, if you look at it, they would have had a representation of 3 names or 4 names in Nifty. I think 3 names are there, but 4 names are there. I think JSW Steel, Tata Steel, Hindalco, and Vedanta. But their weightage in the Nifty would be probably 2.5% at its bottom. Metal stocks did exceedingly well in 2021 and later part of 2020, if you would remember. And by virtue of they having an 8 to 9% weight in the index, they ended up giving the equal weight a big kicker. So the smaller sectors, which have smaller stocks, probably get underrepresented in Nifty 50, but they get proper representation in Nifty 50 equal weight. And that's where, when the market is broad-based, diversified, does well, Nifty 50 equal weight ends up doing better. So as you would appreciate, the Nifty 50 equal weight is not a substitute for Nifty 50. There will be years in which Nifty 50 does well. There will be years in which Nifty 50 equal weight would do well. So we believe that this is a beautiful complement to not just the Nifty 50 related products that your investors would have, but any other product that your investors would have, where the market capitalization is basically based on, or the weightages are based on market capitalization. So if you think of it of creation of a portfolio, you can have low vol on one side, which is a differentiated portfolio. You can have momentum on one side, which is a differentiated portfolio. And you can have equal weight on one side, which is a differentiated portfolio. So within the passive space itself, you can build different portfolios with different weights, depending on the market cycle. If it is your belief that markets are going to be widespread and diversified funds or diversified sectors can do better, and the tail sectors, so to say, or the sectors which have a smaller representation can do better, then you have a certain allocation to Nifty 50 equal weight, which can help. So in the current context, we do have a belief that in the next 3, 4, 5 years, India is going to see a diversified benefit. And to that extent, because the equal weight, as you can see, the equal weight Nifty 50 has diversification of sectors and portfolios which are there. It has a good representation across all the sectors. And more importantly, on valuation basis, if we look at it, the Nifty 50 equal weight is cheaper than Nifty, right? If you look at the price to earnings, it is 18p versus 21p for the Nifty 50, and equal weight is 18. Price to book is slightly cheaper, and dividend yield is slightly higher. So net, you have a good product to complement your existing products. It's a differentiated product. From a product construct perspective, as we all know, the constituents are going to be the same as Nifty 50. So let's say in 6 months' time, any new stock comes into Nifty 50, that stock will also come into Nifty 50 equal weight index. And then the weightages will be rebalanced every 3 months. So if you can see very clearly, say something like HDFC is 1.95, something like a TCS is 1.7. So at the start of the quarter, which is let's say 1st of July 2022, all these stocks in equal weight would have started with roughly 2% weightage. But because in the July month and August month, TCS would have underperformed by more than 15%, right? You find TCS weight coming down to 1.7, while those stocks, let's say the banking stocks like ICICI Bank, which have done far better, they have, because of mark to market, gone to 2.17. So at the end of the quarter, that is when the rebalance happens for the September month, you will find all these stocks again getting realigned to 2% weightage. That is a natural inbuilt, let's say, profit booking and averaging that keeps happening, keeping the 50 stocks constant at 2% at the beginning of a quarter. Then during the quarter, because of mark-to-market changes, then the weightages would keep changing, as you can see. So Larsen has outperformed, and the Sun Unilever has been flat. So just looking at this particular portfolio, you can actually make out which are the stocks which have actually done well and which are the stocks which are laggards. And to that extent, we do believe that this particular portfolio adds a lot of value. If you look at from a long-term perspective also, on 1 year and 3 year basis, the equal weight has done far better, as was shown 2020 calendar year, 2021 calendar year, 22 calendar year is good, while 18-19, calendar year 18 and calendar year 19, Nifty did exceedingly well, and hence on 5 year basis, Nifty is looking better than Nifty 50 equal weight. So if we look at 20 years, again, equal weight is better than Nifty 50. So like I said, it is a good complementing product to the existing products, both on active and passive, that the investor may have. If one does believe that it is better to have a diversified portfolio of equal weighted stocks with of Nifty 50 to have equal opportunity to participate in them, right? I gave the example of metals. It can also apply to autos. Autos at its bottom went to as low as maybe 5% weight in the benchmark Nifty. Well, there are, I think, 5 names in auto which are part of the benchmark. So instead of having 10%, autos had only 5% weight in the autos had 5% weight in Nifty 50, while in equal weight they had probably 10% weight. And when auto did well, that contributes. So if sectors which have lower weights end up doing well, lower weights in Nifty, but having a higher weight in equal weight, like auto or metals, or even pharma pro for that matter, will do well. Your Nifty 50 equal weight does well. And if, let's say, larger weights like IT, right, they do well, then probably there is a chance that equal weight may underperform. So it is a good complementing product. And I think if one does have a holistic view today of creation of a portfolio at a balance, the Nifty 50 equal weight plus some amount of silver and gold ETF plus low volatility Nifty 100 low vol 30 ETF are good combinations, right? So if you want to add a bit of element of momentum, you can add that as well. That is also available. So I think with these 5-6 ETFs, you can create a beautiful blended portfolio, which can help investors wade through these volatile times. At the same time, a fund like low vol will protect downside. Nifty 50 equal weight and momentum will probably give you a kicker if the market does go in the right direction on the way up with a diversified level. And Nifty 50 by itself will probably act as a buffer or act as a foundation on which you can keep building the overall portfolio. Again, because the equal weight, as you have seen, can be more volatile than Nifty 50. If you do SIP in the equal weight index fund, it has been far better. If you look at 1 year, 3 year, 5 years, the SIP returns have been far better, and 10-year is almost equal, 13.9 versus 14.2. So if one is also looking at SIP returns, because the volatility of performance of of the equal weight is higher, your SIP returns can be improved that much more relative to Nifty 50 index. And if you look at 5 years, it's quite significant in terms of the returns. So the fund offer is going on right now. It will end on 28th of September, and the minimum investment is 5,000, which I don't think in these days it is a challenge at all. And again, just to reiterate before we open up for questions, it is important to basically have this portfolio in the investors' portfolio, or add this portfolio in the investors' portfolio as a complement to the existing portfolio, because at different cycles, different types of funds perform, right? Low vol will perform in a different cycle. This fund. So if you can maneuver the proportions and be the right advisor to your clients, then these funds, be it momentum or equal weight or low vol or alpha low vol, silver, gold, can add a lot of value to your clients. With that, I'll open up for questions, if any. Thank you. It being an index fund, of course, the demat is also not required.
So for I think the questions are still coming in. We will just state that the expense ratio for this fund is also very low as compared to the industry norms and the industry average. So the expense ratio for this index fund would be in the range. For the regular plan, it will be under 1%, and for the direct plan, it will be around 0.35%. So, as Chintan mentioned, for a broad-based rally, I think this product is very suitable, and that is the kind of rally which we are seeing in the current markets. So, I mean, maybe equal percentage of allocation can happen both in Nifty 50 index fund and Nifty 50 equal weight index fund, so that it suits both types of market cycles. Chintan, there is one question which has come in, and which says that basically equal weight index is similar to the value investment. Will that be a fair comparison? As you know, the weights are undercut to 2%. Can we say that it is close to value investment?
So value investment is a completely different genre, and if you want to have a look at NV20, which is a Nifty 50 NV20 index, which is also an ETF which we have. And when you look at value essentially means fundamentals which make a set of cheap. You can go on. Fundamental set of factors which can ultimately make a particular set of stocks. You select a particular set of stocks based on fundamental factors which are cheaper. So if you look at, let's say, in this particular instant, the weightage is on the basis of equal weight. The stocks remain the same. If you go by the logic that expensive names end up having higher weights, right, in the index, then yes, to an extent, this index, by virtue of having lesser weights to expensive names which become larger weights in Nifty 50, will become slightly more value oriented relative to Nifty 50. So that is a right, let's say, understanding and a right thought process. But if you go by pure definition of what is meant to be value, It is selection of those stocks which are at a discount to their fair value, or which basically showcase certain strengths either on the basis of return on capital employed, return on equity, dividend yield being higher, and price to earnings being lower type. So valuation or value orientation is essentially focusing on stocks which have discount to their intrinsic value as far as the market price is concerned. That is normally on the basis of either asset value or valuations. However, the equal weight is purely a, a maneuvering of the weightages in the proportion of whatever stocks are there in equal weight, where it is not necessary that you'll always have valuations which are cheaper. Suppose the market goes into a significant overvaluation. Let's say it happened in 2008, maybe even in 2017, where the tail stocks become extremely overvalued relative to the larger names, and larger names in fact become cheaper. We may see that happening in the next 1 or 2 years, wherein suppose IT becomes much more cheaper, suppose the larger names in the banking become much more cheaper on price to earnings, price to book, but the tail stocks become much more expensive, then it is possible that the Nifty 50 equal weight may slightly have a equal valuation or a higher valuation. So it is a observation which is right that currently it is low because the lower names or the smaller names in the Nifty 50 which have lower weights are cheaper on price to earnings, price to book, and they have a higher dividend yield, right? A stock like Vedanta, for example, has a much higher dividend yield. ONGC has a much higher dividend yield. But in the case of, it's not a generalized term. If you want value orientation or value oriented fund in the ETF space, then the NV20 is the right one. Thank you.
Thank you so much, Chintan.
Just an announcement. Dear participants, to ask any questions or queries, please click on the question mark icon on your screen and type in your questions. I repeat, to ask any questions, please click on the question mark icon on your screen and type in your questions. Yeah, Karan, you can.
Yes, the next question is by Miss Deepa Punjabi. She's saying that she's a new investor and her investment horizon is 16 to 20 years. And she wants to design her portfolio with ICICI index funds. And she wants to, her concern is that she wants to protect the downside as well. So Chintan, your take on designing the portfolio with our index funds with a long horizon?
Okay. Karan, I lost you a bit because of network. Can you repeat the question, please? Thank you.
Yes, Chintan, the question is that Miss Deepa, she's a new investor, has an investment horizon of about 20 years and wants to design the portfolio with the index funds offered by ICICI Prudential and wants to also protect the downside.
Great. So I'm very happy to hear that the horizon is 20 years. If your horizon is 20 years and you want to create a balanced portfolio with index funds, I'm assuming that you mean the holistic portfolio. So I'm talking about the holistic portfolio. You can definitely have the right mix of funds. Now, while there is no right answer to how many funds should be part of an investor's portfolio, I would say that momentum, mid-cap, small-cap index funds can be a tactical allocation, right, which you'll have to do. Or you can have a combination of, let's say, Nifty low vol, 20%, 10% in equal weight, 10% in momentum, and 10% in small and mid cap, 10%. So 10% in small cap, 10% in mid cap. The mid cap and small cap component, honestly, if you are while you said 20 years, so I'm just saying that they can be 10%. If you can time it, right, in terms of entering at the right time and probably even exiting, it can give you that much more kicker. Unfortunately, there are no flexi cap index funds, so to say, which actually maneuver their mid-cap, small-cap allocations based on valuations. They are available on the active side, but on passive side, not available. So to make your life simple, if you want to create a portfolio purely on the basis of index, I would just say, and this is a simple tool, may not be true for all kinds of investors, but for most investors, I think you need to have a combination of low vol, momentum, NV20, BSE 500 ETF FOF to give the entire BSE 500 FOF, all the stocks in BSE 500, because you have a 20-year horizon. We do believe that the BSE 500 FOF will basically end up having the best 20-year returns. So you first basically figure out that how much should be the equity, how much should be the debt, how much should be the gold and silver. I do believe having, say, 10% in gold and 5% in silver makes sense today. I do believe 25 to 30% of the investors' portfolio can be in the PSU plus SDL index funds, which are coming up and becoming very, very popular, the target maturity schemes. We ourselves have 2027 PSU SDL. We are going to come out with 28 and 30 as well. So you can create a portfolio basis the client's requirements in that as well. And those are low cost ways of investing in debt. On the equity side, like I said, BSE 500 ETF FOF, that does not have an index fund, but that's the FOF. Then you add Nifty low vol 30 FOF, you add momentum index fund, you add the Nifty 50 equal weight, and whatever is left, that is the mid cap and small cap, either you be tactical or you can have a constant allocation 10%. So once you've created a portfolio, say 60% in equity, 25% in target maturity debt, and 5% in silver and 10% in gold, how much should go when, in terms of when will you time it to become 10% in gold, 5% now, 5% later, silver 2.5% today, 2.5% later? That I will leave it to you, but I think having a 60% equity, 15% gold plus silver, and 20% in debt, since your horizon is 20 years, makes sense. Why am I saying 20% in debt if your horizon is 20 years? Because that always gives you the flexibility if something goes wrong in the world to actually take advantage of a falling market. So today I'm tilted. If you see my recommendations, I'm tilting towards large cap because India relative to the rest of the world is a bit more expensive, and hence it is better to be slightly cautious in terms of your overall allocation. But within the overall allocation, of course, I think products like equal weight, NV20, BSE 500 FOF, low vol, momentum can fit in very well. Add silver and gold to give you that balance, and the target maturity schemes, which is the SDL PSU debt, to give you the comfort of, if there is something going wrong in the world, that will act as a buffer to invest in equities. Thank you. Karan, we'll need to end the call. Unfortunately, I'm running out of time.
Sure, Chintan. So the last question, I can only answer, which basically asks about the details of the fund. The new fund offer is obviously open right now. It is open since 14th and will be open till 28th. And you're free to invest in this fund by going to the HDFC Securities login page. And if you go to the NFO page, you will see the ICICI Prudential Nifty 50 equal weight index fund over there, and you can invest a lump sum or an SIP. You can start during this period, which is till 28th. Expense ratio, as I mentioned, for the regular plan is close to 1%. So these are the details of the fund. Very easily you can invest through the website or the app of HDFC Securities. Another question is about the asset manager of this fund. As this is a passive fund and an index fund, it will be managed by Mr. Nishit Patel and Mr. Kazad, who are actually managing our whole complete bouquet of passive funds. Thank you so much, Chintan, for your time and for explaining this fund beautifully. And thank you everyone in the audience and all the viewers, and also HDFC Securities for giving us this opportunity to present this fund. Thank you everyone. Happy investing.
Thank you everyone. Thanks a lot.